The S&P closed higher today as markets kick off a new quarter, but investors are bracing for President Trump's tariff announcement tomorrow. Joining us now is Joe Davis. He is Vanguard's global chief economist and global head of the investment strategy group. Joe, great day to talk to you. So looking forward longer term, even beyond this tariff issue, what do you think happens to the overall market? What happens to mega cap tech stocks, for example, in this global economic shift? Does the market revert back to historical balance, or does AI keep it moving toward tech?
Well, again, I think, a lot of our research over the past several years, we focused a lot on AI as well as market dynamics. I think we see some positive, transformative ability from AI, but you have to separate that diagnosis from what market returns could offer all of us. And the diagnosis is pretty clear that the equity market, particularly the tech sector, is overvalued by any metric. And so that was a theme of our outlook this year, that there was going to be an opportunity for consolidation and, yes, correction. And I don't think we're through it. I didn't know what the catalyst would be. Certainly tariffs are on front of mind of everyone. But valuations made the U.S. equity market in tech stocks particularly exposed.
So, Joe, do you like other markets better than the U.S. right now? We've been having these conversations given the outperformance of some of the international markets since the start of the year.
Sure. And again, the U.S. exceptionalism from an equity perspective, it's just been really just amazing. But it always had a timestamp on it. I think for the non-U.S., you were always waiting for a catalyst. Valuations would say that the non-U.S. markets had upside opportunity. But what was going to be that catalyst? I think we saw some of that in Germany coming out, some of the defense spending. I think we'll see some positive surprises at the margin out of China. And then you also have to think about fixed income, more to guard against the downside risk of heightened volatility in the equity market. There's no getting around the fact that valuations just make the U.S. equity market vulnerable.
So the 60-40 portfolio was dead. U.S. exceptionalism had people out of the habit of rebalancing portfolios toward international global markets. To what extent should investors go back to some of those more staid rules?
Well, I think, again, if you have the 60-40 as just like your benchmark or where you're trying to achieve, there's still opportunities here. Again, just 6 months ago, it was all AI, all tech, all the time, Mag 7. But the market always underestimates new entrants and, different headlines. And so I think there's opportunities in the large cap and the value space. The historical underperformance past 5 years there's still a great catch up to be had. Outside the U.S., being selective as well. And then again, fixed income has a much higher income cushion than it's had for some time. So if you're really concerned about what we could see, being modestly defensive but staying invested is not the worst idea.